In a world where economies sway like pendulums, the UK stands on the precipice of a decision that could change its future. This drama unfolds as the UK government chooses to abandon a proposed tax cut for the high earners. A move that has ruffled feathers, but according to S&P Global, it doesn't materially affect the looming downgrade warning on the country's AA credit rating. This decision comes at a time when the UK's economy is grappling with the aftermath of Brexit, creating a complex tapestry of economic implications. It's a chess game of sorts, with each move having potential ripple effects on the broader economy. But what does this mean for the common Brit? Let's delve deeper. The housing market, a titan in the UK economy, experienced a rollercoaster ride with the extension and subsequent partial removal of a property purchase tax cut. Now let's dive in and examine the ripple effects of this tax break extension. Picture this, a revival in the housing market, house prices skyrocketing in the wake of Finance Minister Rishi Sunak's announcement. The Royal Institution of Chartered Surveyors survey showed house prices swelling in March, but that's not all. Alongside these ballooning prices, a worsening supply and demand imbalance emerged. A whopping net 60% of respondents expected prices to rise over the next year. Meanwhile, the rental market saw an uptick in tenant demand, and surveyors anticipated rents to rise across the country, except in London, of course. Fast forward a bit, and we see a fascinating shift. The temporary cut to property purchase taxes was partially removed, triggering a drop in demand from new buyers. The housing market, once bubbling with activity, began to cool. The Royal Institution of Chartered Surveyors reported its monthly gauge of house prices easing to +79 in July from +82 in June. The tax cut, which had been implemented in July 2020 to boost property sales during the pandemic, had led to a surge in property prices and new construction. But now, buyer inquiries weakened for the first time in 4 months. Yet, the demand for spacious properties remained high, keeping house price expectations elevated. This change in landscape leads us to an intriguing crossroads. The housing market's fever seems to have cooled, but the question remains, is this a momentary respite or the start of a new trend? Only time will tell. A nation's economy is a complex web of interlinked sectors and industries. A change in one can send ripples across the rest. Let's consider the recent tax cuts and their potential impacts on the UK economy. It's like dropping a stone in a lake. The ripples spread far and wide. The decision to abandon a tax cut for high earners, for instance, may not have a significant immediate impact on the country's AA credit rating, as stated by S&P Global. However, this doesn't mean it's a non-issue. You see, credit ratings are a measure of a country's ability to repay its debts. A lower credit rating could increase the cost of borrowing for the UK government, leading to higher public debt. This could potentially deter investors, both domestic and foreign, from investing in the UK. On the other hand, tax breaks in the housing sector have led to a boom, but they've also created a supply and demand imbalance. With house prices rising, access to affordable housing becomes more difficult, especially for first-time buyers. This could have long-term implications for social mobility and wealth distribution. There's also the rental market to consider. Increased tenant demand is pushing up rents across the country. This might be good news for landlords, but not so much for tenants, particularly those on lower incomes. Furthermore, these tax decisions could impact the wider economy. Higher house prices increase the wealth of homeowners, who may then spend more, driving up consumption. Conversely, if potential homeowners are priced out of the market, they may have to save more for a deposit, which could reduce their consumption. Then there's the construction industry. A booming housing market encourages more house building, which can stimulate economic growth. But when the market cools, as it did when the tax cut was partially removed, the construction industry could take a hit. As the UK charts its course in a post-Brexit world, its economic decisions will shape its future for better or for worse. In the grand theatre of economics, every decision has its critics and champions. As we've navigated through the complex maze of tax cuts and housing market fluctuations, we've encountered a diverse range of perspectives. Some view these tax cuts as a lifeline, stimulating economic growth and invigorating the housing market. On the other hand, skeptics argue that this could deepen the wealth divide, with high earners reaping the most benefits. The housing market, a key player in this drama, saw a boom with the introduction of the tax break, followed by a slight cooling off as the cut was partially removed. This ebb and flow of the market has been a gripping roller coaster, impacting buyers, sellers, and the broader economy. We've also delved into the economic implications, dissecting how these changes could potentially affect the UK's credit rating and overall financial health. The balance between stimulating growth and maintaining fiscal responsibility is a delicate dance, one that requires careful choreography. In conclusion, the tax cut decision is akin to a double-edged sword. It holds the potential to invigorate the economy, yet it also carries risks that could exacerbate existing economic disparities. Whether this decision will be a boon or a bane for the UK economy, only time will tell.